Coming up in today's show, stocks continue to rise and yields continue to fall as the world watches the Israel-Hamas conflict unfold. I take a look at the unfolding situation and what it could lead to and the risks for markets. What billionaire Paul Tudor Jones has to say about all this. The International Monetary Fund sounds the alarm on the bond market and China's troubles deepen. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. Hope you're doing well on this Tuesday. And it looks like we got a bit of a continuation in this stock market rally. With a bit of bullish breadth across the board. Just a little bit of softness in mega cap tech and energy. Otherwise, every sector finished in the green today. And stick with me today because I'll get into the charts later on and give you my opinion on whether this downtrend pullback is over in stocks or not and where we could go to from here. But first, let's continue our coverage a little bit on the most active situation in the world right now. And that's the new war between the Jewish state of Israel versus the Palestinian Islamic resistance militant group known as Hamas, who control the Gaza Strip. There's only about 360 square kilometers, has 2.3 million residents, and they're actually a designated terrorist organization by most Western countries. And like most terrorist groups in the region, they are funded by Iran. And so they did a surprise attack on Saturday morning on southern Israel. And right now, Israel is in the middle of responding to that and looking to take full control of the Gaza Strip. And it's a sad situation indeed, with the loss of innocent lives on both sides of the conflict. To the north in Lebanon and Syria, there are other Islamic resistance groups funded by Iran, and the risk going forward is they too may start to look to make incursions into Israel and try and spread the Israel Defense Force thin across the country, and that could escalate the dynamic a bit here, and that could add further upside pressure to the oil market, amongst others. The other Palestinian-held territory in Israel is that of West Bank, but that's by a competing group to Hamas known as Fatah, and those two groups don't get along, much like most of the Middle East in their entire history. However, I'd say the end game is Israel does take full control eventually of the entire territory, much to Iran's dismay. So it's already pretty much a given that Israel will overwhelm and defeat Hamas. But the question is where to from here. And so there's a few things coming out of this. First off, Biden, like many Western leaders, is rushing to help secure the borders of other countries by asking Congress to start sending money and military equipment and assets to Israel. And this is at a time when he's losing a lot of political support because his own southern border is crumbling with record illegal migrants, a trend we're seeing across many Western countries, and some are saying is raising the risk that some sleeper cells may be forming in Western countries, as it's highly likely a few terrorists have slipped through the cracks, and even potentially some innocents could be radicalized. So that's another risk for markets if we start to see terrorist attacks in Western countries and a resurgence in extremist Islamic terrorists, and something that had been on the downtrend for a few years. And so that's why Congress kept a cap on spending in all categories except defense, and why we're seeing major defense stocks like Lockheed Martin adding $23 billion in market cap just on Monday, with the whole sector ripping up higher and likely to have a strong bid remaining there. Because even if it doesn't become a regional war, the Biden administration is likely to keep wanting sending more money and defense equipment over to the Middle East. And so the biggest risk for markets right now is Iran gets involved, or may start instructing other regional resistance groups to start attacking Israel, and potentially America has to step in, with the additional medium-term risk being that Iran acquires a nuclear weapon, even as a means to negotiation, as they know they can squeeze current-day leaders and win negotiations like we saw in the recent prisoner swap of 5 US prisoners for 5 Iranian prisoners, in addition to the Biden administration unfreezing $6 billion in Iranian money. So even though Iran is saying they're not behind this attack, and we haven't heard much else out from them now, we still may not have heard the last of it from them, especially as Israel is heavily counteracting the attack, and that can't be too pleasing for these guys to watch. And unfortunately, this could be a pathway to a World War III, because if the Israel-Hamas war spills over into a regional conflict in the Middle East, involving the US, at a time they're already trying to support Ukraine, Russia could step up its efforts, who is already getting closely more aligned with Iran, and then that would create an opportune time for China to execute on their long-term goal of reuniting Taiwan with their mainland, as they all view the US as spread too thin, and then before we know it, we're in a World War III with conflicts all over the place. So hopefully that doesn't happen. However, in my opinion, China's just waiting for the right time to take Taiwan, and if the US was already distracted in other places of the world, that would be their best time to do that. And if that were to happen, that would really impact global trade and the price of oil, And of course, travel stocks, airline stocks, and things like that would likely get hammered. That's why we got billionaire investor Paul Tudor Jones, one of my most respected traders out there, who actually called the COVID bear market really well back in January 2020, recently said he would avoid risk assets until the Israel-Hamas conflict reaches a solution. He said mounting geopolitical tension has made it a challenging time to want to be an equities investor right now. And he said rising federal debt has put the US in its weakest fiscal position. And he said the determination of whether Iran was actually responsible is enormous because, again, it has the possibility to really escalate into something terrible. And he's pointed to the booming US debt as making it highly likely we go into a recession because of the vicious circle where higher interest rates cause a higher funding cost, cause higher debt issuance, which cause further bond liquidation, which cause higher rates. He says which puts us in an untenable fiscal position. And so any further escalation in this conflict is going to keep the price of oil going up, which is going to keep the squeeze on the consumer and a bit of a floor in inflation as well. But for now, the conflict just remains in South Israel, and the crude market was actually a bit quiet today, putting in an inside candle and just finishing their day slightly below $86 a barrel. But what the Fed and the stock market really doesn't want to see is inflation coming back 1970s style on a second wave higher, and some strategists point out 4 reasons why that could happen again. With the first being inflation is still above target in every G7 nation, and the market's always full of surprises, so a new price shock could easily unanchor inflation expectations. Economic growth is sluggish, especially in the Eurozone where they're already experiencing stagflation. And looking back in history, the last stretch of the Fed's inflation war is usually the hardest. And that's because the Fed's monetary tightening comes with a lagging effect throughout the economy, and that raises the risk the Fed could overdo it, or something most people are not talking about, potentially underdo it, if inflation does come back and they remain on pause for too long. So inflation hurt a lot of people and markets back in the 70s. Stocks went sideways for most of that decade. Crude oil and gold ripped really higher, and that was actually kicked off by a war in Israel as well, and Arab nations refusing to send oil to the states because of their support for Israel. So hopefully we don't see a repeat of that scenario. However, the US is better insulated compared to the 70s, as they are now the world's largest oil producer. The rout in the bond market is getting more people's attention, with the International Monetary Fund now warning the bond market risks amid fears of another Silicon Valley collapse of an important bank. They said sharp rises in bond yields could pose a risk to banking portfolios, as most of them have huge mark-to-market unrealized losses on their bonds, which is okay if they can carry them through to maturity and get their principal back. The problem is if they're forced to liquidate, so it's kind of walking a tightrope until then. However, we've had a bunch of Fed speakers this week coming in a bit more on the dovish side, hinting that they think they could be done on the hikes, with the latest being Atlanta Fed President Raphael Bostic saying he sees no need for further rate hikes to cool down the economy, and that's because the long end of the bond market's doing the job for them. With that really sharp rise in long-dated yields lately, that's going to have a tightening effect on the economy, credit conditions and borrowing, and I'd say the Fed is banking on that to do their job for them. However, that's contrasting what European Central Bank member Robert Holzmann is saying, that more rate hikes might be needed if new shocks emerge. And he said we're still in a period in which we don't know how long it'll take to come to the inflation that we want to have and whether we have to hike more. And this is a guy who's known more for his dovish stance. So the ECB is not ready to declare victory on inflation just yet either. And in addition to rising geopolitical tensions, what could also help gold out is a lot of global central banks are hoarding it and buying it, as a lot of big countries are pursuing de-dollarization and reducing their US dollar reserves. And this is a trend that's expected to continue for some time yet. And just looking at gold futures today, it was a small range as well, even though it found higher highs and higher lows. I'd say with a pullback in yields and a little bit in the dollar, that should help make that 1830 a bit of a short-term low here. And we'll just see whether we can get back above the 50. And I still think this market has a few tailwinds behind it. And China's property sector still seems to be falling out, with one of their biggest property developers, Country Garden, failing to repay loans, warning that it can't make its US debt repayment obligations, still in the middle of a liquidity crisis. And you can see their sales just falling off an absolute cliff. And they still have the equivalent of 187 billion in liabilities, as the whole sector bit off more than it could chew over the last couple of years. That's why we've still got huge cities and buildings like this just built and empty all around the country. And not even China's own rich trust their own government. That's why they're constantly buying property in Western countries like Australia and Canada, and they're always looking to move cash out of the country secretly. And if caught, they do risk jail time. And I know from being in Australia and New Zealand how much they try and get their money out and purchase property down here. We've even had to create rules to stop them buying up so much of our own farmland. And they're also known to buy expensive jewelry to no doubt keep it off the books when they go back home. And so some say all this mess going on in China may not make for a good time for them to invade Taiwan until they get their economy back in order. However, some others say it could be a good time because the 21% unemployment rate in the youth could be a good distraction, and a wartime economy could employ a lot of those people back and create more patriotism and nationalism, as they constantly fed false propaganda with a Taiwan threat towards them, which doesn't exist in reality. Moving on to economic data, we didn't have much out today, just those few Fed speakers. Tomorrow we got inflation data out of Germany, PPIs in the States, then the big one Thursday, CPI, inflation rate, headline expected to come in 3.6% year-over-year growth. And if those recently higher oil prices find their way into a bit of an upside surprise, that could get yields back up and should make stocks trade lower. The market just slightly firmed its chances the Fed will do a hike in December to 27%, but like I've been saying, I think the Fed really wants to be done here and let those long-dated yields do their job for them in cooling the economy. And even though stocks have put in a good multi-day rally off a short-term low, market still ain't all that excited with the Fear and Greed Index at 32, and same deal with corporate insiders, they did not buy this dip at all. Looking across international stock indices, we got a good bump up in Tuesday's session, all green across the board as they look to move off these short-term lows as well. The VIX coming off again, now down to 17. Put-call ratios are getting lower as more people start to pile into calls again. However, we've still got less than a quarter of all stocks above their 50-day average. And a bit of a change today on the NYSE. We had more stocks making new highs versus lows. However, the Nasdaq, we still had 67 stocks making lows versus 41 new highs. And growth versus value continues to perform well near highs. And there's a look at the 2-year government bond yield, just sitting below 5% now. And the 10-year traded in a tight range again today as well, sitting at 4.65. With bond prices pretty flat, TLT still trying to find a bottom here. The dollar continuing to come off at 105.50, and commodities also traded in a tight range. Looking at stock sectors, we were green across the board, every sector finishing higher, with clean energy leading the way. France coming out with the new climate plan really helped solar stocks. A little bit of a bounce back in global jets after being the worst hit sector yesterday, and energy and oil and gas stocks taking a bit of a breather. Defense stocks found higher highs and higher lows today, now right back at their 50-day, and the defensive stock sectors, healthcare, staples, and utilities all continue to bump up off their lows. BlackRock Barometer continues to trade pretty heavy here. We've got earnings out of them in 3 days. JP Morgan still holding on the best out of all banks, and the big guys, Apple, Microsoft, and Google all coming off a little bit today. NVDA sitting right at its 50, and Tesla actually broke out to multi-week highs. Meme stocks had a good day, up across the board. A little bit of a pullback in those defense makers. There's the Israel ETF, which was flat, and Saudi stocks had a little bit of a bounce back. Pepsi came out with earnings today, came in with a small beat, and just shows that those weight loss drugs aren't having a material effect right now on their sales, even though the market appears to be more worried about it long term. The bounce back in Walmart and big Swiss snack maker Nestle. High-end luxury sales have been soft recently as well. We can see that in the price action of Louis Vuitton, which trades over on the Paris exchange. There's a look at the beaten down stock on my watch list. Next Arrow Energy, potentially making a short-term low here, and the others I've been watching as well. General Motors, Walgreens, and 3M all trading higher today, along with Sphere Entertainment defending its 50-day, and a bit of a bounce back on the telecoms, AT&T and Verizon, after we got those hammer formations on Friday last week. And the regional banks all continue to hold in there and trade pretty well, with a bit of a bounce back in the big guys as well. Okay, so there we are on the S&P 500, sitting at 43.58. We almost tagged the 50-day today, got up to 43.85. We'd have to trade just a bit above 4,400 to fill this gap, and that'll give us about a 61% retracement on this recent swing down. And like I've been saying, I think stocks could top out again around 4,400 and find some overhead resistance, unless we get a big move down in yields. But if that oil price stays strong, and then we see any further escalation in the Middle East, hopefully not, but if we do, that's going to spike oil, which should spook stocks, even though yields will probably come down with a flight of safety to treasuries. So we could be witnessing a bit of a changing dynamic going on in markets here. And just looking at my custom indicators, dark pool percentage, we're back in a neutral zone. S&P 500 oscillator is around neutral as well at 52. So I still think the momentum in the market is to the downside, but we still may have a little bit left in this pullback before stocks could resume their downtrend. But that's all for today. I hope I didn't offend too many people with my political commentary and analysis. Again, that's just all my own opinion. I know there's a lot of different opinions out there, and you're welcome to share yours in the comments below this video as I respond to everyone. So thanks for sticking with Click Capital, and I hope to see you again tomorrow afternoon. Cheers.